Ever wonder why a billionaire needs a loan to buy a yacht? It's not because they're broke. It's because they're playing a game called buy, borrow, die. They have all the stock in the world, but liquid cash? Not so much. Selling that stock means triggering a nasty capital gains tax that bites deep into their fortune. So instead of selling, they just borrow against their own mountain of wealth. It's genius, slightly maddening, and perfectly legal. Imagine you have $100 million in stock. If you sell it, the government takes a huge bite. That's a taxable event, and the IRS is waiting at the door. But what if you don't sell? You take a loan against those shares instead. Loans aren't income, so the IRS doesn't get a penny. It's the ultimate tax avoidance hack. You keep your ownership, you walk away with a suitcase full of cash, and the tax man is left with exactly nothing to tax. The dilemma isn't yours, it's his. How do the ultra wealthy get massive piles of cash without selling their precious stocks? They treat their portfolio like a high stakes piggy bank, using something called Lombard lending. Instead of selling, they hand their shares to the bank as collateral. It's like giving your keys to a pawnbroker, but way fancier. In return, the bank hands over a low interest loan. This is a securities backed line of credit. It's essentially magic. You get the cash, but you don't trigger a single penny in capital gains taxes. Because the bank knows these shares are incredibly valuable, they charge interest rates that are often much cheaper than the taxman's cut. Why sell and lose your cake when you can just borrow against it and eat it too? It's the ultimate keep your assets and spend the bank's money financial life hack. You might ask, why go through all the trouble of borrowing? Why not just sell some shares and call it a day? Well, if a billionaire dumps $1 billion of stock, the market doesn't just watch. It panics. It's a PR nightmare. And more importantly, shares represent control. Every share sold is a tiny piece of the company's future and voting power that you lose forever. By borrowing instead, they get the cash to build those fancy spaceships or buy social media platforms without ever relinquishing their throne. It's all the luxury, with none of the "you're fired" from the board of directors. Welcome to the 2026 economic landscape. Even with interest rates sitting around 6%, billionaires aren't sweating it. Think of it like a game of financial arbitrage. If your assets grow at 10%, but the loan interest is only 6%, you are still capturing a 4% profit on the bank's own capital. So while the taxman waits for a sale that never comes, the math continues to favor the borrower. It's not just a loophole, it's a structural advantage for those holding the cards. Politicians love talking about a billionaire minimum tax. It is a fantastic soundbite for the evening news, but as of mid-2026, it is mostly just talk. While they debate, the legislation stays stuck in the mud. It is like waiting for a slow-moving cloud to rain money onto the Treasury. Everyone talks about it, but the sun just keeps shining on the loopholes. Transparency laws are getting stricter, and banks are opening their books. But for now, the strategy remains safer than a squirrel's nut hoard. Whether it is brilliant or just the ultimate loophole, buy, borrow, die is currently the gold standard. It is the art of staying wealthy while keeping the government's hands firmly off your pockets. For now, the taxman is still searching for the key.